This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.
Hello, everyone. Welcome to Hall & Wilcox's cyber podcast, Cyberzone. I'm Eden Winokur, a partner and head of cyber at Hall & Wilcox. We're excited to be launching season 2 of Cyberzone. For episode 1, I'm thrilled to be joined by Ray Lowe. Ray is a cyber product leader for Australia at world-leading insurer AXA XL. Welcome, Ray.
Great, really good to be here, Eden.
Thanks. And so the title for today's episode is The Keys to Cyber Insurance and Systemic Risk. There's a lot to get through, and I'm confident our listeners will gain a lot from this discussion. So let's jump into it. Ray, you are the cyber product leader at AXA XL in Australia. Can you tell the audience about your role and a bit about AXA XL generally?
Yes, of course. So AXA XL is the property, casualty and specialty risk division of AXA Group, and we offer insurance solutions in now well over 200 countries and territories, covering mid-sized companies to the world's largest multinats. And this includes a full suite of cyber insurance solutions. My role at AXA XL is to lead the cyber and tech business in Australia, which includes Brooklyn Underwriting. And for those that are unaware, Brooklyn Underwriting is our division in Australia that specialises in the SME market. I'm also responsible for product development to ensure our insurance offering continues to be fit for purpose for our clients, and importantly, incorporates all of the continuous learnings from claims and market trends. We also collaborate with the Insurance Council of Australia to support policy advocacy work, and we're really proud to be involved in this work because it is all done with this purpose of shaping positive outcomes in Australia in respect of cyber risks.
That's a terrific overview, Ray. And so I guess what I wanted to do then is sort of dive into a bit more about cyber insurance itself. Sometimes we'll get questions, what do cyber insurance policies cover? And so as a leading underwriter, and for those who don't know what the word underwriter is, it's someone who is a seller of cyber insurance. What does a typical cyber insurance policy cover?
Yeah, so Eden, coverage under a cyber policy typically falls into two buckets, being first-party costs and cover for third-party liabilities. So firstly, in respect of first-party costs, a fit-for-purpose cyber policy should be designed such that it covers the field in terms of those expenses necessary to respond to a cyber incident. And AXA XL, we also have a global panel of breach response providers that can be immediately mobilized, ranging from forensic IT experts, ransom negotiators, privacy lawyers, PR consultants, as well as identity and credit monitoring experts. Now, in terms of specific coverages, our policy first and foremost covers privacy notification and crisis management costs. So this can include forensic costs to determine the cause and scope of the breach, data recovery costs to remove the malware and reconstruct data from backups, expenses to determine the actions necessary to comply with legislation, and that may include notifying individuals who may have had their personal information compromised. Providing credit and identity protection for those impacted individuals is another head of cover, as well as hiring a PR consultant to provide advice in order for our policyholder to mitigate their reputation. Our policy also provides cover for extortion expenses, such as the reimbursement of digital currency to respond to the extortion demand, and of course, expert expenses to provide advice to the policyholder. And then in terms of the recovery phase, our policy also covers BI losses, i.e. the loss of profit resulting from a network compromise that had impacted not only to our policyholders' own systems, but also that of a dependent business, so that our policyholder obtains its tech services from, and this is generally termed contingent business interruption loss under the policy. So these are the first-party coverages. We then move to the third-party liability coverages, which includes any loss our policyholder becomes legally obligated to pay as a result of a claim alleging a privacy and security wrongful act. And your typical example of this is claims brought by impacted individuals whose personal information had been compromised in a cyber attack. There is also cover under our policy for defence costs and regulatory fines where legally permissible arising from a regulatory investigation. And the best example of this is an investigation commenced by our Privacy Commissioner in respect of a data breach. And then finally, to round things off, our policy can also be enhanced to provide cover for consequential reputational harm loss, i.e. the loss of profit as a result of any adverse publicity caused by the cyber incident, system failure, business interruption loss, which is any loss of profit caused by any unintentional or unplanned outage of the policyholder's computer system, and then finally, voluntary shutdown business interruption loss. And that is triggered when a decision is made by a CISO or functional equivalent to suspend or shut down the systems to prevent or mitigate a covered first-party event.
Thanks for that, Ray. That is an excellent and comprehensive summary of what the AXA XL Cyber policy covers. And when you think about it, and I know we're going to get into this in a little bit more detail a bit later, but just when you think about the existing risks that businesses face, it makes a lot of sense for businesses to be purchasing this type of insurance. The next thing I wanted to ask you is really just about the claims environment and what that's doing to sort of policy pricing. And so when we look at what's happened recently, the frequency, the size, the complexity of cyber insurance claims has drastically increased over the past few years. And this is mostly attributed to ransomware attacks, but more recently also to very high profile data breaches. At the same time, there's been a steady flow of business email compromise matters and social engineering fraud, or some of our listeners would think of this as sort of invoicing fraud that takes place over email. Add to that, we've got some regulatory reform, including the Security of Critical Infrastructure Act. There's been an increase in the maximum penalties that can be imposed for breaches of the Privacy Act. So how is this existing claim environment and the future risk of claims impacting pricing for the purchase of cyber policies, and also the limits that underwriters are prepared to offer?
Yeah, great question, Eden. Yes, the cyber insurance market did undergo a period of challenging times in 2021 and the first half of 2022. And this was really caused by the increased frequency and severity of cyber incidents, particularly in 2019 and 2020. Loss trends during those periods were simply unsustainable. And as a result, cyber insurance rates doubled, and in some cases, triple-digit rate increases were required. Insurers were also being very selective in the amount of capacity they offer and which coverage they will offer under the policy. So for example, some insurers excluded ransomware reimbursement from coverage altogether. The other impact is that appetite for capacity had reduced. So for instance, an insurer may have offered limits of up to $10 million in the past. In 2021 and 2022, they limited their capacity to $5 million or less. Now, the positive news is that we are starting to see the market stabilize, particularly in Q2 and Q3 last year, and we expect this trend to continue this year. There have, however, been a string of high-profile data breaches, which have led to swift legislative reforms, as you've mentioned. One of the changes, of course, is the amendment to the Privacy Act to increase penalties for any repeated or serious data breaches to up to 30% of the adjusted turnover of the organization. And from this backdrop of increased breaches and the rollout of more legislative reforms, we continue to anticipate a sustained high-level demand for cyber insurance, driven by both new buyers of cyber insurance and also from organizations wishing to purchase additional cyber insurance capacity. What won't change, however, is that cyber insurers, including AXA XL, will continue to apply strict underwriting discipline, looking carefully at potential clients' attention to cybersecurity and preparedness to determine adequate rate, coverage, and capacity.
So I think one of the key that's a great answer. One of the key takeaways for me there, and something that gets talked about a lot, is sort of the cyber market stabilizing, which I think is a really important thing for people to know. And I've got a bit of a follow-up question. Just on the 16th of February, we've sort of mentioned the Attorney General's privacy reform report that was released on that date. Without getting into too much detail about the 116 proposed reforms, at a really high level, how do you think these sweeping proposed reforms could impact the cyber insurance market and policies?
Yeah, look, firstly, I think the large proportion of the community welcomes the report into our Privacy Act. And I do agree with our Information Commissioner's comments that as the world has become increasingly connected, Our privacy laws need to adapt to ensure that personal information is protected and handled fairly, and I consider these proposals simply reflect the baseline privacy rights expected by a community. I don't think that the proposed reforms will significantly impact the cyber insurance market, although insurers will be monitoring the potential impacts to claims costs if one of the proposals of introducing a personal right to sue for breach of privacy is passed into law. Through the underwriting process, however, more targeted questions will be asked of organisations to determine whether they are compliant with all of their obligations under the various legislative frameworks. We note that many of the recommendations are intended to shift this burden from individuals to safeguard their privacy to now place more responsibility on organisations who collect and use personal information to ensure that they have robust practices in place. And as a final comment, I do think that the public spotlight on the recent breaches, together with more active intervention from our regulators, have absolutely driven greater awareness and changes on an organisation level to elevate their cybersecurity controls and preparedness. And this is good for the market.
Yeah, I couldn't agree more with that last point about the positive benefits. For those interested in learning a bit more about the proposed reforms, there is an article published on the Hall & Wilcox website within the cyber page. So if you're interested, please feel free to go there. And then look, I'm sure there's going to be plenty more discussed about those reforms. They're currently open for consultation until the 31st of March, and it'll be really interesting to see how that then develops. But yeah, really important reforms, and no doubt they'll have an impact on cyber policies. The next question is, I think, a really, really important one. And Ray, I know we've spoken about it before, and it's something that I think is really highly important to insurers, and it's important for the business community to understand this issue too. And that is that cyber is such a unique insurance product due to the risk of a widespread catastrophic event impacting an entire book of business. And so unlike other major risks like floods and earthquakes, which have seen impacting many people in Australia, they're typically restricted to a particular geographic area, whereas a cyber attack exploiting a commonly used piece of software can be launched by anyone, anywhere, and have a major impact on businesses throughout Australia. And this is what we call systemic risk. So what is your view on systemic risk?
Really good topic, Eden. So firstly, it's important to note that systemic cyber risks are inherent in all cyber portfolios, and unfortunately, it cannot be effectively managed simply through risk transference. And the reason for that is because the risk also exists for reinsurers. What it really calls for is action on a policy level. So as a starting point, systemic cyber risk is founded on this broader idea of systemic risk, which is the possibility that a single event might trigger widespread failures, impacting multiple organizations, sectors, or even nations. And I came across a very helpful definition provided by James Schuerman in his 2018 paper. In the cyber context then, he says that systemic cyber risks arises out of a digital network that consists of standardized or functionally interconnected endpoints that permits cascading adverse events throughout. And these events occur at such a high rate of speed that they cannot be contained at all or in a timely fashion. There are two good examples of systemic events that cyber insurers and reinsurers are accumulating risks. The first is this potential for a single vulnerability in shared systems, networks, or technologies that can be weaponized by adversaries to cause maximum damage and cause widespread events. So think about the Log4j zero-day vulnerability discovered in late 2021. The second example is an attack or even simply an accidental failure of a significant cloud software provider leading to an extended outage of that software. It is really important to make the distinction from non-systemic cyber risks. So we're not talking about individualized intra-organization risk that has only one insurance relevant effect, or only a relatively few other risks that are not generated by interconnections. So we're not talking about the Colonial Pipeline ransomware attack, even though the downstream impact was very significant. We're not talking about the Medibank incident or the Optus incident, because those exposures only impact one cyber policy or one tower of cyber insurance.
Yeah, I think that's a really important distinction. So I think for the listeners who haven't really thought about systemic risk in the context of cyber, we're talking about a major vulnerability in, let's just say, like hypothetically, in like a Microsoft product that maybe a substantial number of companies are relying on to use email. And we're talking about a hypothetical situation where something means that companies who use Microsoft can't send emails. That is what we're talking about with systemic risk, and that is something of really high importance to many businesses, and in particular insurance companies and reinsurers who have written risk for cyber policies, where you can imagine a hypothetical scenario where there's a rush on claims coming in if this issue was to occur. I might have a follow-up question on that for you, Ray, and really it's of interest to, I think, to a lot of people. How does an insurer, you get to see things from the inside, within the insurer, how does an insurer prepare for that type of sort of scenario, and what can people be doing more broadly? What could be done more broadly about that kind of risk?
Yeah, so some insurers have introduced limitations to cover depending on the type of event or the cause of the event. However, I do think that given the breadth and complexity of the underlying problem, effective policy making should involve a diversity of stakeholders, from private entities to public groups, and international cooperation is required because systemic cyber risks are inherently global. Firstly, information sharing is key, right? And it should be an exercise to obtain cyber risk data from multiple sources. Data from multiple sources will then allow for a more holistic understanding of the cross-cutting and shared risks that may have cascading impacts within and across organizations and sectors. Through this information, we can then use it to identify, prioritize, and analyze where concentrated pockets of risks exists. And then finally, through this data, we can also understand this relationship between threat, vulnerability, and consequence on critical functions with more precision than before. Another thing that is important is promoting tools to address concentrated sources of cyber risk. So for example, a software bill of materials has emerged in the US as a key building block in software security and software supply chain risk management. A software bill of materials is an inventory, a list of ingredients, if you like, that make up the software components. And the goal is to increase transparency and trust in the critical software that we rely on. And it helps identify vulnerability issues earlier on in the process so that can be resolved before they cause any harm. And then finally, there is also a suggestion to explore a public-private partnership to combat systemic cyber risks. And the reason for this is because there will always remain events that has the potential to generate massive correlated losses at a global scale. For instance, the BI insured losses caused by an extended outage to a significant cloud software provider. And we can then look to the established public-private partnership that have demonstrated their potential in other challenging areas, including extreme weather, natural catastrophe, as well as terrorism.
Yeah, I mean, that all makes perfect sense. And it's something that, you imagine, needs to be done to try and offset the risk of the aggregated claims. The next topic I wanted to jump to, and this really came up on the back of the Medibank breach. There are some really strong voices in the community by politicians and leading business people to ban ransomware payments in Australia. What are your views on that?
Look, there are arguments on both sides of the coin. I mean, the primary case to make payment of a ransomware demand illegal is that these payments enrich organized crime. Therefore, payment of ransoms effectively encourage and facilitate future ransomware attacks and increase the intensity and frequency of these attacks. However, in my view, this policy decision to ban ransomware payments and the indemnification of those will remove a significant mitigating mechanism off the table for victims of a ransomware attack. And I anticipate more data breaches may arise as ransomware gangs pivot their business model to immediately start to monetize the stolen data. Example, in the case of a health insurer, direct extortion of members with sensitive health records. I also anticipate that data recovery costs, forensic costs, and BI losses will increase, which may impact cyber insurance affordability. And it may also cause unintended consequences to the community. So for instance, think about the irreparable damage to vulnerable sections of the community if the PII contains very sensitive personal information. Also, if the attack impacted an organization that provides critical infrastructure, it can lead to an extended outage of those critical services to the community. In the case of the Colonial Pipeline incident, the decision to pay the ransom was to avert the significant interruption to the public. And so if there is a ban on ransomware payments, it takes this mitigating mechanism completely off the table. Another unintended consequence is that you may have a situation where organizations simply stop notifying breaches and secretly pay the ransom in order to stay afloat, which can then impact the quality of the data collected by the government under our mandatory notifiable data breach framework. And so for those reasons, we consider that further analysis and consultation with important stakeholders is required, particularly involving insurers, to ensure that an informed policy decision is made rather than a knee-jerk response, which would only make the problem worse.
I think that's really insightful response and covers, a really good overview of the key issues. It's a topic that I find particularly interesting to think about. I have done some reading up on what happened when some countries tried to ban kidnap and ransom insurance payments in the 70s, when these very debates seem to have been happening all those years ago. And from the reading I've done, it doesn't appear that the banning of the payments actually stopped it from happening. It just sort of drove it into the black market. And similarly, we've seen similar things in some of the states in the US who have tried to ban ransom payments, only to find out those payments weren't stopping. They were being driven into the black market, and it did look to impact the transparency with notification under other regulatory obligations. So that point you hit on at the end there. So it's a really interesting space. Reasonable minds can differ on it. And I think your comment that consultation should be prioritized is spot on, and I couldn't agree more with that. Coming to the next question, this has been a terrific discussion, really, really insightful. And I wanted to then move to a question that I'm having a lot with IT companies, with corporates, with just many different stakeholders. In particular, sort of brokers and corporates in the last year, who have said that they, as a client or clients that they have, they're actually getting rejected from obtaining cyber insurance, which I think is a really important thing for people who are listening to appreciate. Cyber insurance is like any type of insurance. Insurers want to make sure that they're insuring a good risk. You can't get car insurance if your car's not roadworthy. And I think that's the way to think about cyber insurance. Cyber insurers have moved from just sort of handing out policies to those who want them to really trying to assess the roadworthiness of network infrastructure and security for companies. And really the main reason I've been told that companies aren't getting it is the lack of network security or the sector that they operate in. Ray, again, so you're in this amazingly unique position where you are a seller of cyber insurance. You're the head of product for AXA XL in Australia. It'd be great to hear from you about what are the keys to obtaining cyber insurance, and what can a company do to get better premiums or higher limits? I'm sure many listeners will be very eager to hear about this.
Yes, another good question, Eden. Look, I think it's firstly important to note that the underwriting criteria can differ by market segments and also by industry. Example, the underwriting criteria for a small organization differs to that of a large corporate. And similarly, for example, the exposure analysis for a large healthcare provider differs to that of insuring a law firm. In saying that, AXA XL has a set of minimum security criteria that applies to all risks, which includes enabling MFA for any and all remote access to the corporate network. The organization needs to demonstrate that they are safely securing backups and have an acceptable patching cadence. This list, I have to stress, is non-exhaustive, and some controls are more critical depending on segment and industry. Again, cyber insurers, including AXA XL, are adopting strict underwriting discipline, looking carefully at potential clients' attention to cybersecurity and preparedness. And for those organizations that truly understand their cyber exposures and have tailored their security controls through an informed decision-making process, are best positioned to secure the most favorable terms.
Yeah, I think that's really helpful. I guess some companies just realistically are not in a position to get cyber insurance within the time frame that they would like. and hopefully those companies are in the process of uplifting their systems, working with the right people to be able to achieve that. Ray, I just wanted to ask a follow-up, and I think you might have some views on this, but for those organizations that are unable to purchase cyber insurance for whatever reasons, are you aware of any solutions that can be offered by cyber insurers?
Yeah, so for those organizations that can look to alternative risk transfer solutions when they seek cyber insurance, this could be a captive, a structured risk solution, or a mix of both. As you have mentioned, as a result of cyber market dynamics, many clients are considering increasing their cyber programs retention, or they are being forced to increase the retention due to escalating claim costs or premium increases. And we are seeing that risk managers are looking to captives as a potential source to alleviate the resulting larger retentions. And we have seen captive involvement in cyber insurance programs have increased significantly in the past 2 years. Some companies are also using their captives to address gaps in cyber coverage. Structured reinsurance programs can offer multi-year coverage and protection against risk volatility over time. So to take you through an example, a 3 to 5 year reinsurance contract with a term aggregate limit and premiums with profit and risk sharing elements in place could help the organization avoid annual risk spike from large events or aggregate losses. Also, such a structure could potentially enable a captive to reduce or redeploy some of the capital it would need to hold without such multi-year structured reinsurance support. When a client does not have a captive, AXA XL can work with the insured to issue a structured solution that covers their losses and expenses within the retention layer on a reimbursement basis. And we have and continue to work with our clients to settle on coverage wording that matches the primary coverage to the extent possible and where it fits within our guidelines and risk appetite.
Yeah, I think that's really, really helpful for listeners to know. And so, the key takeaway from today is if you're a company and you've got cyber insurance or not, speak to your broker, ask them about Ray, ask them about AXA. If you don't have it and you want to sort of try to come up with a solution, get your broker to reach out to Ray to have a discussion about what AXA XL can do for you. And the other thing I just mentioned is that, if you don't have the insurance, if you've got the insurance, it's great because you'll have a whole response process built into that policy and you get to speak to experts who deal with this type of risk every day. If you don't have the cyber insurance and you have an incident, I do strongly encourage you to reach out to experts, ourselves or other experts, but I think the way to think of it is, responding to a cyber attack can sort of be like heart surgery. If you need to get heart surgery, you need to go to a heart surgeon. Don't go to a GP, don't go to a brain surgeon or an ear, nose, throat specialist. It's really important to go to people who have the experience dealing with this type of risk because it is unique and it can make a big difference to the company's downtime and the overall risks that the company faces on the back of an incident, which we're all trying to avoid, but they do unfortunately. So I think that was it. Ray, thank you so much for joining us today and sharing your insights, experiences, and expertise. It's been really valuable. And again, for those wanting more information about the policies and products that Ray sells, and please have your broker get in touch with him. And also, of course, as always, a big thank you to our listeners. We trust that you found today's information useful, and please reach out if you have any questions or follow-ups. You can find my details on the Hall & Wilcox website, hallandwilcox.com.au. Both myself and Ray are on LinkedIn. If you enjoyed today's episode, please rate, review, and follow our podcast. You can subscribe on our website to be notified of new episodes. Have a great day, everyone, and stay cyber safe.